In this video, I'm going to explain to you why this formula is so important and how it completely changed how I think about money. So a quick 30-second background on this story. Ever since I was little, I loved math. Do you remember those math practice workbooks you had to do in elementary school? Yeah, well those weren't enough for me, so I would actually ask my mom for more homework. Yeah, I was a weird kid, but she would do it. I mean, she printed out pages and pages of multiplication problems for me. And I remember I would sit down at the table and I would actually time myself 60 seconds how many I could do without missing a single one. I mean, I liked math so much that was my first job, really. At 16, I actually got a job as a private tutor making $20 an hour, tutoring high school students in my neighborhood. Now you gotta remember, at 16, $20 an hour is more money than I've ever made before. I let that get to my head a little bit. In the first month, I remember buying myself a new pair of Nikes, treating my friends out to lunch, and just generally feeling like $1,000,000. Thankfully, by 17, I wised up a little bit and started saving more of my money. I also began reading and learning about investing more. And that was when I learned the formulas behind the concepts that completely flipped upside down my perception of money. You see, investing at its core comes down to a simple principle. You start with an amount of money, let's say P. Then you take that amount of money and you invest it, hoping to generate a return. Let's call that R. If you invest that money for a number of years, T, your money will compound and grow into a larger sum over time. This is when your money makes you money. This is the theory of compound interest. Now, to find out the amount of money that your money is making in a given year, just take the amount that you have and multiply it by your rate of return, R. This is how much money you made in your 10th year of investing. So a question emerged in my head. How long would it take for that initial investment to grow so big that it actually paid me back my original principal amount every year? In other words, when will the amount of money you make each year be the same as the amount of money that you put in? So basically, we want to solve the above for T. Now, with a little bit of algebra, we get this. The time it takes is equal to negative the natural log of your rate of return divided by the natural log of your rate of return plus 1. Note that this formula only depends on your rate of return. For example, if you invested $1,000 at a rate of return of 7%, after 39 years, your investments would get to the point where they pay you back $1,000 every single year. Think about that. You can push this even further with higher rates of return. If you can achieve 10% annual returns, it'll only take you 24 years. If you can get that number up to 12%, it'll take less than 19. The formula is even more impressive when you're starting with a larger initial investment. And that is exactly what Warren Buffett, one of the world's most successful value investors, did in January 1988. After the stock market crash of 1987, Warren Buffett purchased $1 billion worth of Coca-Cola shares when they were trading around $2.45. Today, Warren's stake in Coca-Cola is worth an astounding $17.3 billion and pays his company over $600 million in dividends every year. This decision was one of Warren Buffett's single greatest investment decisions ever. Learning this concept taught me 3 valuable lessons. First, the power of compounding interest. Albert Einstein once said that compounding interest is the 8th wonder of the world. As a prudent value investor, Buffett showed us just how true that statement is. Second, delayed gratification. Academic studies have shown that the ability to delay gratification is one of the most effective personal traits of successful people. It got me thinking about the purchase of my Nikes. Why own the shoes when you can own the company? And finally, start saving and investing as early as you can. The sooner you put that money to work, the sooner it can begin working for you. You can't change the past, but it's in your power to start investing today. So there you have it, the formulas behind the most powerful concepts in investing. When was your aha moment about money? Let me know in the comments below, and be sure to subscribe for more content like this 3 times a week. Until then, thanks for watching.